In 2006, and even into 2007, it seemed that the downturn in housing wouldn't have a large impact on the broader U.S. economy. The impact would be limited to the subprime mortgage market. But as we now know, the troubles in the subprime mortgage market spiraled into the Great Recession, a recession that devastated both Wall Street and Main Street, the broader financial markets and ordinary people. The reason this occurred was that the U.S. economy was particularly vulnerable in the mid-2000s to negative events. As I discussed in my last episode, this vulnerability stemmed from four major factors: the huge bubble in housing, risk that permeated the system and yet was largely unknown to investors, and highly indebted households and financial firms. In this episode, we'll trace the timeline of the crisis, showing how the problems in the subprime mortgage market ravaged the entire financial industry and shook the whole U.S. economy, resulting in the most severe and long-lasting recession the U.S. has experienced since the Great Depression. The first signs of the Great Recession came in mid-2006, when some households defaulted on their mortgages. In the euphoria of the early 2000s, when home prices seemed like they would rise forever, these households had borrowed too much money and bought housing they couldn't afford. As a consequence, delinquency rates on residential loans started to tick up. The rate of delinquency before 2006 was about 1.5%. And by the end of 2007, those delinquency rates doubled. They would double twice more before the Great Recession was over. These delinquency rates were highest among the riskiest borrowers and in the states that had experienced the greatest booms, like California, Arizona, Florida, and Nevada. The debt burden dragging down households meant that demand for bigger and more expensive housing dried up. This in turn slowed the growth in home prices. According to the Case-Shiller Index, mid-2006 was the moment when housing prices reached their peak and started to turn around. Now this was a big deal, since over the past 15 years, housing prices nationally had always risen. Housing prices fell slowly in the beginning, then price declines started to pick up speed. Making matters worse, the earlier euphoria of investors had evaporated and pessimism had taken hold. Whereas earlier, investors thought that housing prices would rise indefinitely, now those investors worried about how many households would default on their loans. The loan delinquencies, the fall in housing prices, and the pessimism hit investors and financial firms hard. Their highly opaque financial assets that contained spliced bundles of mortgages still, at the end of the day, contained mortgages. So when households defaulted on those mortgages, those once highly sought-after mortgage-backed securities and collateralized debt obligations began to lose value. This led investors to want to sell their risky mortgage-related assets. A director of fixed income at Goldman Sachs, for example, told the sales team that they should, and I quote, refocus efforts and move stuff out even if you have to take a small loss, end quote. The trouble with this, though, is that in late 2007 and early 2008, everyone wanted to sell their mortgage-related assets. And when everyone's selling and no one's buying, prices plummet. Mortgage-related assets that a year ago were highly prized now were selling for pennies on the dollar. This graph shows that some of the riskier mortgage-backed securities were selling for 1/10 of the price that they were selling for 2 years earlier. This steep decline impacted all companies that held mortgage-related assets, even those that had decided not to sell those assets. This is because an accounting rule called mark-to-market meant that companies had to update their balance sheets according to the asset's current market value. The resulting write-down caused the asset side of the firm's balance sheets to deteriorate. The more mortgage-related assets a firm held, the worse its balance sheet looked. It was at this point that disaster seemed to roll from one company to the next. In July 2007, Bear Stearns, one of the 5 largest investment banks in the U.S., announced in a letter that 2 of its hedge funds that specialized in subprime loans had effectively no value left for investors. In October 2007, UBS, Citigroup, and Merrill Lynch announced substantial losses due to their exposures to bad debt. Then, the second major shock to the financial system occurs in March 2008. Due to worries about Bear Stearns' exposure to real estate losses, investors refused to lend money to Bear Stearns. This resulted in a type of bank run and pushed Bear Stearns to the brink of collapse. Before that happened, though, the U.S. government brokered a deal with J.P. Morgan to purchase Bear Stearns. Eventually, Merrill Lynch would also succumb to its mounting losses and be acquired by Bank of America. Problems multiplied over the next few months as companies tried to reduce their risk exposure and obtain additional capital. Asset prices continued to fall, companies' balance sheets continued to deteriorate, and financial players lost confidence in one another. As an example, Fannie Mae and Freddie Mac, two large government-sponsored entities that owned or guaranteed around 30% of all U.S. mortgages, faced losses so large that the U.S. government had to take them over and place them into conservatorship. And then, on September 15th, 2008, the most significant and damaging event of the entire financial crisis occurred. After being unable to find any buyers and after the U.S. government refused to bail the company out, Lehman Brothers declared bankruptcy. This was the largest bankruptcy filing in the entire history of the United States. Thousands of workers were instantly unemployed. Panic spread throughout the financial world. Global stock markets plunged. Lending ceased. In the words of the chairman of the Federal Reserve, Ben Bernanke, the bankruptcy was going to have huge impacts on funding markets. It would create a huge loss of confidence in other financial firms. It would create pressure on Merrill and Morgan Stanley, if not Goldman, which eventually it did. It would probably bring the commercial paper market and the money market mutual funds under pressure. So there was never any doubt in our minds that it would be a calamity, catastrophe. And just as Bernanke mentioned, the Lehman failure did indeed cause a system-wide economic collapse. Investors, worried about the viability of other investment banks, refused to lend them money. Borrowing costs spiked, further worsening their ability to remain liquid. These liquidity fears prompted Goldman Sachs and Morgan Stanley to switch their legal designations to commercial banks in order to access the Fed's lending facilities. This move was made in desperation because by converting its legal designation, those banks were subjecting themselves to more intense regulation and supervision. Also, AIG, a giant insurance company, required an $85 billion bailout from the U.S. government. At around the same time, there was a run on money market mutual funds. This was utterly terrifying because money market mutual funds often provide short-term loans to non-financial companies, allowing them to meet their financial obligations like payroll. If these money market mutual funds failed, companies would struggle, and by extension, the whole U.S. economy would suffer. Fortunately, the government moved quickly to provide liquidity and insurance to the money market mutual funds, staving off one source of pain for Main Street. But Main Street was hit in other ways. Specifically, the fall in home prices meant that household wealth had taken a huge hit. Households, it's estimated, lost $6 trillion worth of equity in their homes. That's a decade worth of built-up equity vanished. On top of that, large losses in the stock market meant that retirement and brokerage accounts plunged in value, further reducing people's wealth. This extreme loss of wealth led consumers to dramatically cut back on their spending. Spending on durable goods like cars, appliances, and furniture, for example, fell by over 15% or $180 billion. Companies, of course, noticed that their products weren't selling and so decided to cut costs by firing workers. Lots of workers. According to the Bureau of Labor Statistics, almost 9 million workers lost their jobs over the next 2 years. So just as households were becoming poorer, companies fired millions more, magnifying the economic strain. And, to put it bluntly, the strain associated with the Great Recession was more than financial. There's research indicating that unemployment significantly increases the risk of depression and undermines people's emotional well-being. People lose their motivation and skills for working. They might also forego health treatments or reduce their savings for retirement. Evidence suggests that workers who are unemployed for long periods of time have lower wages and less stable jobs for the rest of their careers. Evidence also suggests that the children of parents who become unemployed suffer. Their grades are lower at the time of graduation. They have worse labor market prospects, and they feel less parental support at home. At its peak, the Great Recession cost millions of workers their jobs, and almost half of those unemployed would remain unemployed for over half a year. Millions more were forced into part-time jobs when they wanted full-time jobs, were marginally attached to the labor force, or were so discouraged by their job prospects that they stopped looking altogether. If you include all types of wealth, the Great Recession resulted in $16.4 trillion of wealth to disappear. That's a full year's worth of income from the entire U.S. gone. Major companies, both financial and non-financial, went bankrupt or were acquired. It was in this environment of utter economic collapse that the U.S. government and the U.S. Federal Reserve both enacted uniquely large policies intended to stimulate the economy. In the next few episodes of Econ-Files, we'll discuss these policies, their goals, and their consequences. Thanks for watching.